Sean, as we enter 2026, what's your macro outlook?
Well, we're pretty constructive on the outlook for this upcoming year. A bunch of reasons for that. We like to follow the mantra, don't fight the Fed, don't fight the trend, watch credit. All three of those are positive right now. So we know the Fed's already cut rates by 175 basis points. They're set to be dovish and cut rates further this year. The trend of the general market indices is positive, hitting new all-time highs, and credit conditions are pretty easy. Loose financial conditions, spreads are very tight, credit's in a good spot.
So last year, the S&P was up around 16%, not a bad year, coming off another good year, which came off another good year. What are some of the bullish trends? Can you be a little bit more specific?
Yeah, there's a lot of bullish trends right now. Number one, I think investor sentiment is overly pessimistic, at least it was for most of last year. One measure of that is the American Association of Individual Investors Sentiment Poll, AAII. In 19 of the 52 weeks, only 19 of 52 weeks, there were more bullish investors than bearish investors. In our opinion, that's too bearish for where the market ended up being at new all-time highs. Earnings growth, the S&P 500 is set to have earnings grow by about 14.5% in calendar year 2026 this year. And then in 2027, we see earnings growing again by about 12.5%. To us, earnings growth, wall of worry suggests higher markets. If we apply a 22 forward multiple to those earnings estimates into the future, that gets us a target of about 7,700 on the S&P 500.
And you don't think you're pushing your luck at all after these last three very good years? Give me the bearish case, because you said the bears are out there. Do they have a point at all?
Oh, there's some concerns out there. There's a lot of geopolitics, right? We're seeing that right now as number one. Although we normally see geopolitics as more noise. And then after an event, the market generally goes back to its previous trend. Others, we are going to have a new Fed chair, right? We know that Fed chair is probably going to be dovish. How dovish is that Fed chair going to be? Will the market respond to that in a favorable way or not a favorable way? Historically speaking, new Fed chairpersons get tested. For example, within the first 6 months of a new Fed chair at the helm, on average, the S&P 500 has experienced a max drawdown of about 14.8%. Another concern for us as we look towards the middle of the year is, hey, it's a midterm election year. Historically speaking, the market generally has about a 20% peak to bottom drawdown in a midterm election year. So we do think we'll see volatility Q2, Q3, but again, strong now, volatility in the middle part of the year, then we think we finish the year strong.
Would you mind commenting a little bit more about the Federal Reserve and how many cuts do you think we're going to get this year? Because if things are so great and the economy is so strong, I don't know why we even need those cuts, right?
Well, that's a debate, right? There's a lot out there. A lot of people out there don't think we need any cuts. They didn't think we needed cuts last year, right? So the Fed's cut now by 175 basis points already, right? 100 basis points in 2024, 75 basis points last year. The market's pricing in 2 cuts. We think with the new Fed chair, we know coming down from the administration, they're going to be advocating for more cuts. We think inflation continues its glide path lower towards the Fed's 2% target. That being the case, as well as general unemployment rates moving higher, jobless expansion, we think that's going to push the Fed to cut at least 2 times, as the market thinks, maybe even a 3rd time.
And then finally, over at Clark Capital, where do you think the best places are for investors to make money? Stocks, bonds, and which sectors? What do you like?
Well, first and foremost, we manage multi-asset class solution sets. We are overweight equity. We have been overweight equity in our multi-asset class portfolio since April of last year. We went max overweight equity in the tariff volatility in mid-April. We dialed that back a little bit in July, but still overweight. So we still like stocks relative to bonds. We still think, even though we've had 3 double-digit percentage gains years in the S&P 500, that does not preclude us from having a 4th. And we actually do think that's going to happen. So we're still overweight equities. From the standpoint of sectors and styles and market caps, we had a pretty good overweight to large cap growth. We've dialed that back recently as we've seen the market participation broaden. We've added some small cap exposure, added some value exposure. So we're more overall benchmark allocated right now in our US equity allocations. Furthermore, we do advocate and believe in investing internationally. That level of diversification, sure. People say, well, why go overseas? S&P 500 has outperformed international markets in 12 of the past 15 years. Right, they didn't last year, right? And from a valuation standpoint, international markets are trading at about a 30% discount to the S&P 500 on a forward basis. That's a pretty good valuation discount. So we would advocate allocating there as well.
All right, well, thanks for coming on and talking about it.
All right, my pleasure. Thank you.